My title is Head of Personal Finance, but you may know me more from my background as 20 years as a personal finance and investment journalist. I worked for Money Observer magazine and MoneyWise, which Interactive Investor actually owns. We own two independent magazines. I also worked for many years at the Investors Chronicle, which is at the Financial Times Group, and I currently also have an investing column in the Financial Times. So today I'm going to talk about Interactive Investor's Super 60 fund list. I'll explain how it came to be. I'll give you a flavour of the selection, and I'm also going to finish with some thoughts on how you can improve your fund portfolio, including some rather unusual inspiration. So we're in a world, an investment world, in which there are too many choices, often too little time, and the obvious thing to do is to just ignore stuff. There's so many choices out there, 5,000 funds available to investors in the UK. That's if you include exchange-traded funds, ETFs, and investment trusts. And this is why so many investors just don't get on with the business of investing. And our research shows that beginner investors in particular are put off because they just don't know where to start. So, earlier this year, we launched our Super 60 fund list, and it's designed to provide a menu of high-quality choices across a variety of markets and investment types. So what's the purpose of a fund list? So on this, I'm going to quote the Investors Chronicle in an article from the end of January this year. They said, "We firmly believe in the usefulness of fund lists. They are, despite their despite their flaws, not huge flaws, based on rigorous analysis, and they make sense of a huge landscape for investors. And lists do encourage investors to be more analytical. Their focus on costs and risks is a reminder that performance isn't the only thing to consider, and they open investors' eyes up to new sectors and to bits of rubbish in their own portfolios. But no matter how good a fund list is, all of the above flaws simply underline the number one rule, that investors, that's all of you in this room, have to do their own research. So use fund lists wisely as a starting point, not a finishing point." That's the words of wisdom from the Investors Chronicle. And that is how I would encourage you to use the II Super 60 too. So what's different about our list at Interactive Investor? We have very rigorous selection. We have no commercial considerations. We include investment trusts and ETFs alongside active and passive funds. And we feel the list is very much designed for different ranges of investors, for both beginners and experienced, and we've got options in every major asset class, and we've got different choices per asset group, so there should be something for everybody in there. We've deliberately included the investment trusts and ETFs because we know Interactive Investor customers do often prefer investment trusts and ETFs, use them a lot. And we've deliberately looked at the full collective investment universe using the best in class for each sector. So actually, in some categories, we have favoured one asset type over another. For example, in the property sector, we've only included investment trusts because their closed-ended structure is more appropriate for an illiquid market. Cost has been a big consideration. But also, we have to consider whether an investment offers value for money. So who chooses the list? Here's a few mug shots. I'm afraid this is our investment committee. Not all of the members, but a few. They meet quarterly, they guide the fund selection process, they're responsible for approving the funds on the list, and we've got a range of skill sets within the committee. So members include personal finance and specialist investment journalists at Interactive Investor, such as myself, Lee Wild, and also some of the very experienced team from Money Observer magazine. which is owned by Interactive Investor. So we've got Andrew Pitts, Faith Glasgow and Kyle Caldwell on the committee too. We've also got our experienced investment analysts, Dimitri Lipsky and Rebecca O'Keefe. And we also have, I'm afraid John, I didn't get a photograph of you. He is here in the room. But we've got John McLaughlin, who had a 24-year career at Schroders. And we can also draw on independent external expertise when needed. There's a 7-step selection process. The process begins with an initial screening of the entire universe. There's an overall cost assessment for the value for money. We've got performance analysis, risk profiling. We discuss the results among Interactive Investors analysts and experts. And there's a selection and approval process. But that's not the end of the process. We monitor it on an ongoing basis for any red flags, such as which I'll come to later in the presentation, which may make us think that we should be monitoring a fund more closely, or maybe with a view to removing it from the list. And then once a year, we're going to repeat the whole entire selection process, beginning with the refresh of the universe that we take them from, and we'll work through all of those steps again. So that clean sheet approach means we consider any new fund offerings and also any significant market events that have happened during the course of the year. So the list is going to remain fresh. But in spite of that, we don't really want to have a high rate of turnover either. So when we select these funds, we expect the majority of them to retain their Super 60 rating over several years. We're very focused on long-term investment processes with this. Now, very importantly for us, our Super 60 comes with a steer on how all the funds might fit into a portfolio. We've put them into this matrix, which is done by asset group. So we've got a whole different different equity asset classes in there, from UK to global. We've got income options in there too. We've also got fixed income funds in there and alternatives such as property and gold. And within each asset class category, we've got a range of different types of investments. So if you're interested in low cost, there should be an option. There's always a core option. There's an income option. There could be smaller caps and also adventurous sort of more high conviction choices for people who are willing to take higher risk or who are more feeling a bit more adventurous with their portfolios. So we've got, within the selection, we have 12 passive funds, which you can use to keep your costs low. And of course, the passive management of a fund intends to track the returns of an index. It doesn't have a fund management team taking active decisions. And passive funds typically cost less than active funds too. Whereas on the other hand, you've got an actively managed funds which have their individual professional fund managers who are making investment decisions, and they're aiming to deliver a higher return than the index. Many fund lists don't include passive funds, ours does, but we've also got 33 active funds, and 15 investment trusts as well. So what about passive funds? I mean, the advocates of passives say they're brilliant, they should form part of every investor's portfolio, they're low cost, they guarantee you're not going to underperform the market. And these passive funds were selected for their ability to track their benchmark indices and for their low costs. However, we all know that some investors also don't like the idea of passives because they don't like the idea that they will be following an index down during a bear market. And there's a fact that some active fund managers out there are so good that we're all willing to take the risk that they may fail to outperform the market. And you know, we all want to try and find a fund or investment trust that's going to smash the market, and we like to back managers because we believe they're adding value, and very much so we believe that often they do. So I've also selected 4 active funds and investment trust case studies from the Super 60 that I'll go through next. I just emphasise they're not recommendations on a personal basis. They're just a selection that I thought you would find interesting. So, first up is the, I don't know if I can say this in one breath, but CFP SDL UK Buffetology Fund, run by Keith Ashworth-Lord. Now, I met Keith when he first launched this fund back in 2011, and I did back it from the very beginning with the fun tip in the Investors Chronicle. But I just really liked his approach and his conviction. His style is called business perspective investing. He's following Warren Buffett's principle of buying shares in good businesses for less than their intrinsic value and then holding them over the very long term. And the fund has consistently outperformed since it launched. The manager, Keith, does complete extensive research upon deciding to invest, and then he puts a significant amount in, so he's a very high conviction manager. And as a result, the fund's only, what's called relatively concentrated. It's only got around 30 stocks within it. So he knows all of those 30 really well, and he believes that returns are going to come from those underlying companies, not the market. Now, it's down as an adventurous option due to that concentration. And we think if you have something simpler like a FTSE All-Share Tracker Fund or one of our core fund holdings, this could complement it as a satellite kind of holding next to it. Here's one that some of you in the room, I'm sure, are familiar with. City of London Investment Trust we think is a compelling core option for income investors. It's got a formidable reputation as an income-producing investment trust. It's actually poised to notch up 53 consecutive years of rising dividends, and shares in the trust have a good yield. It pays a quarterly dividend as well. And Joe Curtis, he's a value investor. He looks for companies undervalued on a medium-term basis that he can invest in over the long term. It's very well diversified. He likes to run his winners. His portfolio turnover is low. And it's one of the largest UK equity income trusts with one of the lowest ongoing charges. Again, we're having a focus on value and reducing charges here. Now, Fundsmith Equity Fund is actually one of the most popular funds with interactive investor customers. It has been on the most popular list for many, many months, but that didn't deter us from putting it on this list. Terry Smith is one of the best-known managers in the UK. He's got a very strong track record on this fund, and he's got a very long, distinguished investment career. He's also sometimes referred to as the English Warren Buffett. He tends to invest in quality growth, defensive-type companies that are all able to sustain high rates of return on capital. And he has a focus on brands and franchises that deter competition as well. So it's performed very well over the long term, and that outperformance has been driven by a bias to consumer staples and healthcare, as well as his stock selection. We did do a note on pairing this fund with Artemis Global Income, which is a value-focused fund. We thought they're both in the selection, but they would make a good pairing. They do things slightly differently. One's a quality growth strategy, one's a value-focused fund. Or alternatively, if you wanted to diversify away, you could pair it with SLI Global Smaller Companies, which is Fundsmith focuses on the big caps, the big companies, and then you could have that smaller companies fund alongside it, but also investing on a global basis. This is an interesting one that made it onto the Super 60, Rathbone Ethical Bond. It came up in the research, it ranks very highly, It's got a higher income target than some of its peers, and income is paid quarterly. We didn't choose it for its ethical stance, but it got in there anyway because it had delivered such great performance, and also the manager's style and his rigorous process was very attractive too. He predominantly invests in investment-grade bonds, and that he uses an approach that takes into account economic and political trends alongside company analysis and thematic ideas. And the ethical screen, which is in there, actually makes him reject a third of the potential universe for investing. But the fund manager regards it as an extra level of investment diligence and rigour within the portfolio, and it's contributed to great performance. So yeah, an ethical fund within the selection. So now I'd like to ask you to use your voting pads. You've seen there's a lot of inspiration out there, both from passives and active fund managers. I'd like to ask you how many funds you actually hold in your portfolios. So please use your voting pads now. Ooh, that's very interesting. 0 to 5 wins with 36%, and 18% of you have more than 21. So it looks like you're keeping quite tidy fund portfolios. Yeah, I think I'm pretty impressed with that. So I don't know if everyone's going to benefit from my unusual investment inspiration. But it's all about tidying up. Marie Kondo is sort of a global phenomenon now. She got a Netflix show that started in January, and that's prompted a mass decluttering of sock drawers around the country. British charity shops have been reporting a boom in donations, but Kondo evangelists say we can benefit from applying her organising tips to all the other areas of our lives, and I like to think that can be done with investing too. So I'll suggest you don't even have to have Marie Kondo in your thoughts. You could just think, I'm going to have a general tidy up, and ISA season, which we're now in, is probably a good opportunity to do that. You need to get everything in one place. That's her first principle. She says, throw all the clothes on the bed. So this is get all your investments in one place, and that includes old pension funds that you may have forgotten about. It's time to dig those out, see where they're invested, get the full picture of everything that you own, and then only then can you start to focus on the tidying up. And of course, over a lifetime, many of us do accumulate lots of investments that were good ideas or fashionable at the time. Climate change and absolute return funds spring to mind here. They went through phases of being very fashionable and written about an awful lot in the personal finance pages of the national press. So if you've bought something every ISA season for 20 years, you may have a mishmash of investments that don't have much of a master plan behind them, or which you simply may not have time to track. But also, you may be falling foul to something that the legendary US fund manager Peter Lynch termed diversification rather than diversification. So essentially, too much diversification, and I might be thinking about the people who are admitted to having 21 or more funds in their portfolios here, may be a bad thing. If you own too many investments, and within the funds there's going to be potentially hundreds or thousands there, you might be just ending up with a kind of the equivalent of a tracker fund that will perform in the same way, and you've got to be quite careful here. So if you do have too many, and I'm not going to say what the right number is here, I don't know myself, but I think it's just for you to get a view on that for your own portfolio. if you have too many, you might as well go full Marie Kondo and buy the index tracker fund and scrap everything, and that might spoil your enjoyment of investing. But yeah, it's difficult to sell investments. That's the problem. And Marie Kondo has a nice focus within her show, which is always focusing on what to keep rather than what to throw away, because that's helps you focus your mind. You have to be honest about each investment. Has it performed well? And would you buy it today? You know, when you bought it years ago, it seemed like a good idea at the time, but would you do the same thing today? And that's what we're trying to do with our Super 60. When we're looking at our red flags, we spend a lot of time monitoring our Super 60, checking for these things. So we check for performance, how has it been performing? We check the manager, has there been any changes? We check the strategy, has the manager made any changes to how they're managing the investments? We check the size of the fund. Has it got too big to be following the same strategy that it was at launch? And we also follow economic and market changes just to see if it fits in. So there's lots of things to think about in terms of what might make you think twice about a fund today. Now, I've given you some food for thought in terms of Marie Kondo and red flags. So how many funds do you think is the right number for your investment portfolio? So press button 1 for 0 to 5, 2 for 6 to 10, 3 for 11 to 20, and 4 for 21 plus. Over to you, vote now, thanks. Oh, that's slightly different to before. But yes, fewer of you are thinking 21 plus after that little exercise, which suggests to me that there are a few people in this room who are going to have a bit of a tidy up. I'd be interested to hear from you about what that might entail. So, well, thank you very much for listening to me.